Before we announced the earnings, or you announced the earnings and we reported them, and during the tease, I had said more than $6 trillion. And now
it's just a shy
and
under.
now the number has come under $6 trillion.
Yes.
Barely 5.98.
5.98.
Actually, today is higher.
It is today. So, but just speak to what's happened in the market and what's happened in the marketplace, because clearly there have been outflows, not to the extent of some of your competitors.
Well, we had inflows. So we had inflows in the fourth quarter. We had $124 billion or $123 billion of inflows throughout the year. The industry had huge outflows. We had, I would say the year was a year of records, good and bad records. We had, which even surprised us, we had record inflows in ETFs and iShares in the fourth quarter. And we had $81 billion of inflows in the fourth quarter in ETFs.
How much of that, by the way, was in the last 2 weeks?
I don't remember the last 2 weeks, but it was, what I do remember, it was pretty spread out, and I could get into the composition of what happened there. And over the year, we had record inflows in our alternative space of $16 billion. And then in the center, that's where we had outflows. So you're seeing this hollowing out of the center. You're seeing the barbell of alternatives and index products becoming more and more dominant, and we're seeing that throughout the industry. We estimate the industry's mutual fund worldwide minus ETFs had outflows about $450 billion in 2018. And so, in addition, we had record revenue increases in our technology business, up 19%. So, where we saw the negative, we had about $90 billion of outflows in the index mutual funds, where people just take exposures. Now, that's a full year.
That's the low-fee stuff, too, right? It's
tiny.
Yeah.
Even with that, our institutional business had net new revenues. So even with those outflows, because of the composition and more alternatives, we had increases in fees in our institutional business.
That tells you the difference between the institutional and retail investor, or what does that show you?
Well, no, I would say across the board, and let's step back for a second. Investors have a real choice to pause, unlike the last 10 years. They can put money in a money market fund and earn close to 3%. That is another reason why we saw outflows in fixed income. You could be in a money market fund instead of having any duration.
Right. And you think that's changed the psychology of the investor market class right now?
Absolutely. Because you are paid to pause. But overall, I think the biggest issue, as you discussed, Andrew, we had huge equity declines in the fourth quarter. We had commodity declines. We had about a 5% decay in our asset base, not because of outflows, just because the market fell.
Right.
And that's what you saw in our assets. I mean, we have benefited as a firm over the last 10 years with rising equity markets. We believe over the next 10 years, equity markets are going to be higher, but we are going to see those types of swings. Now, we all know the fourth quarter was a pretty severe downdraft in the equity markets, and that reflects in our NAV. But we had organic growth, unlike the majority of the industry, and we are. And let me just say one thing: what I think is really differentiating us, and also I think it's changing the whole composition of the markets. We're seeing in the wealth and the retail side, investors move away from stock picking, moving away from buying a product to working on models and really now portfolio composition. We all know, and all the academics will say 80%-ish, 70%, depending on the academic, of the performance is through asset allocation. Now, I'm not trying to suggest everybody knows how to do a proper asset allocation, but you're seeing less focus on an individual stock, less focus on a product, and we're seeing more of the wealth managers and their firms focusing on portfolio composition. And this is how we have been always talking about it at BlackRock. We've talked about we're a solution provider. We're working on that. We have many models for asset allocation. We have risk management tools. And so, we are benefiting by that change. And I think 2019, I think we're going to see some very large benefits by providing the risk technology. I think, we announced about Morgan Stanley. All our financial advisors are now on Aladdin for wealth management. We have more demand for that product than almost any
platform,
product.
just so everybody's clear.
We announced last week that we are now using iShares as a technology with Royal Bank of Canada, now using the iShares platform for their own ETFs. So we're white labeling our ETFs. They're using our technology. It is going to say to their clients, RBC iShares. We have...
How much, do you have a big business doing that already?
This is the
first
beginning, but I believe it's going to be quite large.
Yeah, and to do a white label branded service for a lot of people.
But also using our technology and then intersecting that, and it saves them a lot of money too.
But that's not just a brand licensing situation.
No, we are doing the manufacturing for them.
Gotcha.
Similar to what we have done with, with other firms.
Speak to this, because I know a number of your employees and other people on the street want to understand it. You did announce a layoff plan.
Yes. We did it already.
I know, but just explain what that's about.
Well, it's a painful moment for me. It's a painful moment for many people. We have grown in our headcount by 7% a year for 5 straight years. Not all of our businesses were performing at the levels, but most importantly, we needed to reorient the organization. We needed to have the capacity to invest in all the new areas that we see where we could invest. And we determined that the best way to do it is to re-footprint some of our areas in the world.
But this was mostly just across, wasn't it?
It was across the world.
It looked like it was an across the board.
It was. There was some concentration in some of the businesses where we believe, there's more to do. But from January 2018 to now, even after that, we're up 3% headcount growth. So it was just more of a reorientation that we thought we needed to do. We don't have a culture that weeds out 5% every year like some other firms do. So we don't have that. We believe that creates a negative culture. But unfortunately, sometimes we have to do this. This is probably the 3rd time in the last, 15, 20 years we've done something like this. So I don't enjoy it. I went home depressed. But it is what it is.